Everybody, welcome back. We are in the It's Your Money series. This is week 3 of 8. My name's Trevor Murphy. I am the host of the series. Peter Kote is moderating, and we have the one and only Laura Tarbox today and next week doing our financial planning sessions 1 and 2. I apologize. I have a little bit of a chest cold here. Thank you for the wonderful feedback so far. We've taken note of everything that you guys have sent us. Before we start, I would like to turn it over to Pete to introduce our charitable sponsor this week, Newport Beach Public Library.
Hi, Kanga. How are you doing today?
Hey, good. Thanks for this opportunity.
Yeah, I don't think the library's been open, has it?
It is. It's at full capacity. It's been open for 2 weeks now, but the space that we usually host the series is not. We're not at that point where we can let people come in and gather. So we're hoping, next year, hopefully, fingers crossed, we could do that.
The Newport Beach Public Library is a government-supported entity, and it's also the Newport Beach Library Foundation is the charitable organization that supports the public library. Do I have that correct?
That is correct.
And talk a little bit about what is that mission of the foundation?
Yeah, so our mission is twofold. One is to obviously provide valuable analog and digital resources for the library, which we've donated books, DVDs, the licensing of digital resources, web streamings, and ebooks, which has been very, very big during the pandemic because people have been accessing our e-branch. But we also provide the spaces like media labs, so people can access computers where we purchase the computers and furnitures. And another thing, what we do is also fund the educational and cultural programming, such as, the financial series, and obviously the most notably the annual Witty series, which, we bring in speakers like Doris Kearns-Goodwin, John Mitchum. So all these are the twofold mission that the public library does, that the foundation does for the library.
And how much do you spend on an annual basis, and how much do you raise from the community?
So we actually have been, so we did this math, and we have the community of the Library Foundation, members and donors have contributed nearly $7 million over the last decade.
Wow.
So we are putting all that money, it takes a lot of money, it costs a lot of money to get all that free access for the library. Obviously the government does fund, but not as much, like it only goes so far. So all the, all the membership, the donation through sponsorships and through stocks and cash and all of the legacy gifts, they're all the ones that's funding the library currently. So
what does it take to become a friend of the library?
Nothing much, just, a $50 could, the $50 can buy you 2 children's books. So it doesn't take a lot. If you can become a member, if you want to just donate generally to the foundation, whichever method can work. We also have a new website, which we're very proud of. We try to make it more community friendly and easy to use. It's nbplf.foundation, and we have our membership page. We'll let people know what they're donating for, and if they want to become a member, obviously that money, what that money is going to, as well as if you want to just donate generally as well.
Yeah, and I must say, you've got one of the most beautiful libraries in all of Orange County.
Yeah.
Plus, from a financial point of view, you have so many resources there that are free to the public, from Value Line, from Wall Street Journal, Barron's. There is no other library in all of Orange County that has as much financial literacy resources than the Newport Beach Library. So I want to thank you. And by the way, and thank you for allowing us to be at the location. And I hope we see you in the fall.
Yes, we hope so too. I really appreciate that. Yeah, it's not zip code You know, anybody can be actually a library card. You know, everybody can get a library card, become a member. It's not
You don't have to
solely
live
based
in
on zip
Newport
code.
Beach.
Exactly. It doesn't have to be a Newport Beach thing. So that's the beauty of this library, which I really, really like.
Yeah.
So.
And we're all getting used to being Zoomed and being electronic and everything else. But I'm looking forward to seeing you in person. Conga, thank you so much. Really appreciate it.
Well, thank you, Trevor. Thank you, Peter. I really hope to see you guys.
Take
bye,
care.
Laura.
Thank you.
Bye-bye.
Bye. Thanks.
All right.
So let me real quick. So please remember that the materials for this session will be on our webpage for the It's Your Money workshop materials for week 3. You can see it's down here already up there. And we have Laura's Ask First as well as Pete's other articles that he's put up there. So Pete, why don't you go ahead and introduce Laura. Laura, I will stop sharing and you can put your Ask First up there. And if you have issues, let me know. I'll remove mine.
All righty. Get better, Trevor. You sound hoarse.
Yeah, I know.
Okay. Just a bit of a rehash as to what we've done the first couple of weeks. First week, what we did was kind of give you an introduction of the program. Congo, who represented the Newport Beach Library Foundation, is one of our charitable sponsors. We only have charities that sponsor the workshops. And the reason simply is that if we had a bank or an insurance company, all of you would be getting a call afterwards saying, how did you like the program? And then trying to see if they can schedule an appointment with you so they could sell you something. So none of the charities are going to call you. And I think it's really good to give. So I hope you pick out 1, 2, or 3 charities and include them in your money and estate plans.
And I have all of our sponsors listed, I think, at the end of my presentation, Pete.
Great. And it's not just those sponsors, but any charity. It's what you're passionate about is what is important. And it tells other people in the world what you're passionate about because you're leaving them money. And money is one of the things how we express our interest and concern along with our time. We start all the programs with the Ask First form, and it's, can we make that screen a little bigger? I don't know if we can or not. It's kind of hard to read.
Oh, really?
I can, let me try to get it up. So Laura, please stop sharing.
Okay.
Sorry.
Fine.
The reason why we use and go through the Ask First form is because these are just the basics that we need to know about someone who's going to be handling our money. And if you don't know these simple things, then you need to ask. And so, Laura, you've got your bachelor's degree from UCLA. We won't tell the USC graduates and about that. How many years have you been a CFP?
Almost 38, I think.
38. 38 years of experience as a financial advisor. Tell us a little bit about your background, how you got into it, and where you are today.
Yeah, so Pete didn't make me admit that my degree from UCLA is not in business or economics, it's in English. And I was kind of trying to figure out what I wanted to do after graduation and really fell into the business, working for someone who had just left a big brokerage firm to start kind of a small brokerage firm situation. And so I did stock options trading, which was very exciting. We had the Quotron machines in the old days, and you could see your trades go by. And it was fun for a while. And then when I lost money for some clients for the first time, it wasn't so fun. And I questioned whether this was the business I wanted to be in, though I loved all the financial world. I loved investing. You know, I really knew that there was something there, but the whole sales process and then, of course, you know, the product focus just didn't sit right with me. And I discovered the Certified Financial Planner program, which was, you know, not that old at that time, almost 40 years ago, but it got into the CFP program, a couple years of courses, and got my license. And then I immediately started teaching the CFP program and taught at UCLA, USC, Cal Lutheran, and then was the program director of the CFP program at UC Irvine for over 20 years. And I fell in love with the concept of financial planning and the idea of, you know, it's not just the investments, it's the tax planning, estate planning, budgeting, you know, all of that put together, risk management, and really integrating that and helping people meet their financial goals. So after a decade, it didn't happen really quickly. I made the switch to drop all my sales licenses to work just on a fee basis in the late 80s, early 90s. And that was kind of a new trend at the time. There weren't many people doing that. Now there are, thank goodness, more of us, but really leaving the product sales side and focusing more on the client financial planning service side. And I know if you attended the last session or so, you heard a bit about some of those differences, but I've been practicing as a fee-only firm since the early 90s.
And that's why you put relevant licenses, none.
Right.
Because
that's a good thing. I mean, sometimes people think that's a negative, and, you know, we think of that as a good thing. That means I'm not going to sell you anything.
Right. You're not insurance licensed, you're not
Not
securities
real estate,
licensed.
you know, none of that.
Yeah, and
Right.
but you are registered with the Securities and Exchange Commission through FINRA.
Right. Yes. Yes, exactly. And then as a registered investment advisor, which again doesn't require any testing. Or well, this is a small test to get that, but it's mostly a registration so that you can be regulated by the SEC. And in fact, there are surprise audits. We had not been audited in 14 years, and we had a surprise audit in March last year, just, you know, because there was nothing else we had to do in March last year.
Yeah.
We had a 2-month virtual surprise audit in March last year. And I just have to say, we were one of fewer than 5% of the firms in the country who got a completely clean, no action letter on our audit.
Yeah.
And they go through everything. I mean, they're trying to make sure you're not doing something where you could steal client money, basically, is the bottom line of that.
And if they did find something, what that would mean is that you would then have a disclosure if it was serious enough.
Right.
So
So
that's where that disclosure comes from.
Right. And you can check the disclosures on the broker check or the SEC IARD site to see if there's any disclosures.
And all you have to do is look up Laura's name, Laura Tarbox Equity, and you will find her. Business relationship, you at all times will serve as a fiduciary. Let's go down, scroll down a little bit on the screen. And compensation. Compensation is huge. How do your clients pay you?
Fees. So no commissions, no kickbacks. We're not paid by mutual fund companies or insurance companies. Only fees from clients. Sometimes that's a flat fee. Sometimes it's a percent of the assets on accounts that we manage, which is the most common way that people get paid on our side of the industry.
I'm just going to round it off and say you've been into business 40 years. So you're not the spring chicken. And so what do you charge? How do you charge? And what's your minimum?
So we generally require a $5 million liquid asset minimum. We charge on a $5 million account, we would charge 0.75%. to manage that account. And that would include all financial planning that we do. And that's what we're going to get in today. What does that mean, financial planning? What are all the things you should expect from a financial planner? And occasionally we've charged flat fees for some of our family office clients where we're doing bill pay and some of that stuff.
Okay. And then the importance is that the client pays you. And so your only obligation is to the client.
Yep. And of course, fully disclosed, which is not the usual thing in our industry. And the more regulation that gets imposed on us, the more that people figure out how to work around it and not disclose things. It's really kind of crazy. And I feel for the consumer because it really is complicated and hard to figure out who's who and what's what. And that's one of the things we want to try to do here is help you find the right kind of advisors, the good advisors, if that's something you're looking for.
Yeah. And there are good advisors in the community. And so if you don't have $5 million for investable assets, that does not mean that you're not going to get good advice from someone.
Yep.
Laura has taught, I would say, hundreds of wannabe financial advisors. And there are many, many good advisors in the community, but they dwarf in the sense of all the brokers in the community.
Right. Yep.
So we can help you find a good financial advisor if that's what you want. If you don't, and if you want to do it yourself, go through the financial planning process that we're going to talk about in the next 2 sessions. If you have a simpler financial life, it's not going to take you a lot of time. If you have a lot of assets, good for you, but it's going to take you more time. And it has to be a little bit more sophisticated. Are you?
And I just want, as I always do, I'm happy to talk to anybody, or email is probably a good way to reach me. My email, I think, is on my handout. If you're looking for someone, and I can give you a couple names. Of course, Pete does too. I mean, we know the same people. We try to find a good match. Some advisors focus on certain things. Some will do hourly planning. There's some good options in our community here. So I'm happy to try to help anybody find the right fit there.
Yeah. One of the, I always repeat this, and you probably are sick of hearing it for some of you. But when I ask a group as to why they picked a financial advisor, David, the answer is usually he's such a nice person. He's been with the family X number of years. And that's a lousy reason to have your money with the person. First of all, find out and figure out, how are they paid? 2, are they a fiduciary as far as concerned? 3 is, how do they operate their practice? Are they an active manager, a passive manager? Do they offer a financial plan? And let me ask you, Laura, you already mentioned part of your practice is you include the financial plan within your fee. Is that correct?
That's correct. And we really don't offer, just a couple exceptions, investment only relationships, because the planning is so important to what we do, and it's so integrated that it's part of what we do ongoing. And there's a lot of different ways that advisors do financial planning and deliver financial planning. And we can talk about that a little bit, but for us, it's an ongoing process where we're doing pieces of it all the time, very integrated into what we do. It's interesting. I actually have a friend who's helping me with some work here at the office and kind of doing some bookkeeping stuff for me. And she's always had an interest in the industry, and I think, and she's always had a big interest in investments. And she's been here about a month now. She's kind of like, I don't really hear you guys talk about investments ever. It's like everything else in the world, we're talking about financial related. But after 40 years, we have a great investment team that we kind of have that down. And it's all the other things that make it really complex and interesting for us, but more valuable to the clients. You got to get the investing right, but it's all the other stuff that can be so much more important to your financial well-being.
So this particular session, we're not going to be talking about investments in this financial planning one. We'll talk about investments in the next week. We'll talk about the overview of the investment world, because the investments is the apple rolling off the cart. After you get to know someone, etc., some of the things that we're going to go through. So let's get started on the program.
So go ahead and share, Laura. If anyone has any questions, I'll be fielding them and getting them to Laura and Pete in due course as we go through this. The apple falling off the apple cart, is that like a World War I reference, Pete?
Yes, it is.
Okay.
Well, wait, go back a slide. Okay, let's talk a little bit. This is you.
Yeah. So and this is me and some of my background there. By
the way, besides Laura being highly competent, she's a wonderful, nice person.
I am nice.
Which is really important as well. But all the other things has to come first.
Yep.
And she's very charitable oriented. It's been involved in many community programs, too many to mention. But if there was an award to be given for niceness, Laura, you would get one.
Thank you, Pete. So my firm has had a couple different names over its history: Tarbox Equity, Tarbox Group. Now we're Tarbox Family Office, and we changed the name a few years ago because it's a little more reflective of the fact that we do offer family office services. We're considered a multi-family office where we're doing tax prep for some clients, bill pay, that sort of thing, in addition to all the wealth management services. So that's kind of the why of the name. A lot of our clients just said, we just like the name because we feel like you're a family and we're part of the family, which is, that's more important than anything to us. And that's how we feel.
How many clients do you have per advisor?
So per staff member, there's 8 clients per staff member here, which is super unusual. So we have just a little more than 100 families, and we're almost at $1 billion in assets that we're managing. So, only having 100 clients, a brokerage practice, at one of the brokerage firms, they would have hundreds, maybe 1,000 clients.
Up to 5,000.
Yeah. So, that is probably one of the most telling ratios that you can get from your advisor is how many clients per staff person do you have in your firm? So, we're obviously doing a lot of things for our clients all the time.
Let's go to the next slide.
Mm-hmm. And I know we talked about this, but I just want to say where this came from. Before I was going to be doing this It's Your Money presentation a couple of years ago, I just started collecting all the flyers I was getting for financial presentations at my house. And I think I had just refinanced, and my big mortgage amount went public, and all these people, list sellers, put my name on it. And I got all these invitations to seminars, and I tracked all of the advisors and looked them up on BrokerCheck. And this is what I found right here in Orange County, and the local venues offering steak dinners. You're not going to find a good advisor doing a free public seminar offering you a big expensive dinner. It's just nuts. And daily the fines on these big firms, and I just don't understand why people trust these big brokerage firms and banks. It's
hard to believe, but your Wall Street firms are predatory. They seek out vulnerable individuals. And if you think the prospectus is a full disclosure document that really helps you as a client, then you must be somebody who graduated with a PhD and a law degree and can really understand what you're reading.
Yeah. And it's not just, I mean, it's not just unsophisticated people. I mean,
No,
we have
it's
very sophisticated, very wealthy clients who have worked with these firms and still work with some of these firms. And, you know, people want to believe that they have a secret sauce or they have
Bernie
access
Madoff.
to something you can't get elsewhere. And none of that exists, you know, very, very rarely. There's certain funds that, you know, you may not be able to get into, but most of those you don't want to get into anyway. But that's one of the pitches of these big firms, their exclusivity and their access to some of these deals. But
and what's really amazing to me is that the fines that they pay, 13 billion for JP Morgan on the mortgage-backed securities, Goldman Sachs, 500 million. And it doesn't affect their bottom line.
No. And if I had one thing, you know, for the small firms, if we had one thing on our record, we'd be out of business practically. It's just like, it's crazy. It's crazy.
So let's go to the next slide.
Yep. So one of the things, it is difficult. The terms are mostly meaningless and interchangeable, and different ones of these terms come in and out of vogue. You know, I think wealth management seems to be, you know, the term of the day. Wealth advisors, we use that term. You know, financial planner isn't used as much. I think that people calling themselves a financial planner now probably do some bit of financial planning. But anybody can use these terms. Anybody without any credentials or licenses can use any of these terms. So that doesn't mean anything, what people are calling themselves.
We can give you a certificate of attending the It's Your Money program and hang it up on your wall and call yourself a financial advisor. You probably have spent more time than most designations in the industry.
Right.
Studying this stuff.
Yeah. So the different kinds of firms, I know this has been discussed quite a bit, but independent firm, an independent RIA, registered investment advisor firm with no licenses, you know, that would be our recommendation, to seek out a firm like that. However, there are now independent RIAs that have an insurance and broker dealer relationship. That's very common. A common thing is that groups of brokers are breaking away from Wells Fargo, Merrill Lynch, Morgan Stanley, and forming an independent RIA because they figure they could make even more money doing that. And
RIA stands for what?
Registered investment advisor.
Okay.
And they take their old kind of tactics and approach and try to put it in a somewhat independent model, but then they're also selling insurance, or they're, you know, selling real estate and packaging their own real estate deals. That
LPL is an independent RIA. Commonwealth is an independent RIA.
That's the middle. They're the independent broker dealer. So with LPL or Commonwealth, an advisor can put their own name on it, but they're still really affiliated with a broker dealer. And those are the heaviest sellers of some of the bad products, the untraded REITs and the annuities, et cetera.
Yeah, and the wirehouse would be UBS, Merrill Lynch, JP Morgan.
Yep. And then, you know, banks, insurance companies, or trust companies, it's the same thing. That, you know, they have lots of conflicts of interest. They're trying to make money on you in lots of different ways. I mean, the biggest way that a brokerage firm makes money on a client is actually they're on their cash balances, you know, for the big firms. I mean, there's crazy ways that they make money, and the incentives are just, you know, not lined up in the client's favor, for sure. So compensation method, again, the lines are blurred here. The biggest one is, we hear all the time, is people saying they're fee-based, and that because we want advisors to be fee only, and to participate in this series, I think Pete's relentless about vetting advisors to make sure that they aren't, you know, don't have a side insurance business or something, that they're truly fee only compensated via client fees, no kickbacks, no sales of any type. But advisors will say that they're fee-based, which means they're fee and commission. It's a euphemism for fee and commission. It doesn't mean anything. So lots of times I'll hear people say, oh, my advisor's fee-based. I'm like, oh, that's bad. You want to be fee only. And I do want to talk about the fiduciary thing just a little, Pete, because
Sure.
that term is being co-opted by the brokerage firms and they misuse it. And there are times when they say they're acting as a fiduciary, but that's why in the Ask First form, it says, will you act as a fiduciary all the time? So it's a little, I am not using that term as much as I used to, because I see the brokerage firms using it all the time. I see on the flyers for the free dinners, people who are fee only on the investment side, but then they sell you annuities insurance and they say they're a fiduciary. Well, you can't be a fiduciary if you're selling insurance. So, and the problem is that's a loophole in the regulations because insurance is state regulated. The SEC doesn't really care that much what you're doing on the insurance side. They're looking at the securities world, and it's California that regulates the insurance. And so there's these advisors who say they're fee only, but they're selling insurance and they're falling through the cracks. So, you know, that would just be an outright question. Do you sell any kind of insurance ever? And, you know, that would mean that they're not a true fiduciary and not fee only. So what you should pay attention to is credentials, registered investment advisor, again, a registration, not so much a license or a credential. CFP is, you know, the real thing. It's the primary designation for financial planning, typically a 2-year educational course and then a rigorous, I think still 6-hour exam, passing rate in the 35–40% range lately, I think. Chartered financial consultant is a financial planning designation, but from the insurance industry. So nobody who's not in the insurance industry would have the CHFC. You came from the insurance industry if you have that, but you're an insurance agent with some financial planning expertise. But when you see CHFC, you want to be sure that you see if they're selling insurance. And some of them may have stopped selling insurance, but that's something they must have done at one time in their past. And then chartered financial analyst, CFA, very well-respected designation, where the CFP is, you know, deep and wide as far as all the topic areas: estate planning, insurance, tax planning, investments. Chartered financial analyst is deep in investments. It's all investment analysis. So someone who's managing a mutual fund and doing individual stock analysis might be a CFA. And that's a 3-year exam cycle. You have to pass one before you go on to the next one. Again, a very low passing rate, even as you get to the final exam. Very tough license to get. And all of those have the CFP, CHFC, and CFA have ongoing continuing education requirements. So experience, you know, so important. I mean, there's just so many things that an experienced advisor has seen over the years. And what's interesting to me and why I still love what I do is there's always something new. I mean, here we have a whole new tax thing facing us, which keeps it kind of interesting and exciting. But, you know, based on having a lot of experience going through these, I think that kind of helps us navigate that. But there's just so many situations that come up, and there's some really young, newer advisors who are so good, and they know the right questions and they know the right people to bring in. So, you know, experience is important, but if there's a younger advisor who's not been around as long as they're connected to the right groups and the right people, and they have a peer group to kind of bounce off of, that, you know, that can be a really great fit also. Rapport and trust, you can't hide things from your financial advisor. It's not going to be a very good relationship if you do that. I just remember being on the Schwab advisor panel, and they were vetting different focus groups and trying to put ads together, whatever. But they had these couples in there, you know, with the double mirrored thing where we were watching them answer these questions, and they would say, you know, I'm at this brokerage firm, and I really like my advisor, but I just don't trust him. And, you know, when he's kind of not looking, I sneak money out of my account. I was like, what is going on? It's just crazy. Yeah. You need to
or the client that has 5 different accounts.
Yeah, with different places. Yeah, and that's a question we get a lot. You know, I just am afraid to put all my eggs with one basket. And if you're with the right advisor, your eggs aren't all in one basket, but it's certainly a legitimate concern. And that's why it's important for someone with a small independent firm to have an independent outside custodian, the last bullet there. Because, I don't want clients writing checks to me for their investments. They're writing checks to TD Ameritrade or Charles Schwab. That's where their account is. They get statements from that outside broker. That's a requirement. The Bernie Madoff situation, he was making up fake statements. There were not, third-party corroborative statements from an outside custodian. So that's very important.
Who do you use as your custodian?
We use TD Ameritrade and Schwab, which is, now kind of the same thing, but they're not yet the same thing.
I went into a Schwab retail store yesterday, and they're now wearing 2 badges. One of Schwab,
really?
Yeah, 2 badges.
Wow. Yeah, the integration in that, it's interesting. So I say I've been on the advisor board of both organizations over different times, and
They have different cultures.
and we watch that closely because it's a very independent relationship that we have with TD and Schwab, and we can change at any time. And in fact, we're looking at a couple other options just in case we want to have an option, in case we really don't like how things are going at Schwabatrade, as they're calling it, when it's all Schwab, we have other options. We could go to Pershing or Fidelity or some other organization because we're independent from them. But we're going to go where we get the best pricing,
Prices,
the best
service.
Yep.
Let's go to the next slide.
So these are some organizations where you can get some resources. We talked about the broker checks. Again, just to get advisors. You should always interview more than one person. Everybody has a really different approach. There's not a right way to do financial planning. There's some certain, kind of standard practices, accepted practices, but everybody practices a little bit differently, and it's got to make sense to you. What the approach is, what the investment approach is, et cetera. So, these are kind of the main questions that we're trying to answer for clients, and we're asking these questions even if these aren't the questions that people come to us with. And usually people seek out an advisor or a new advisor when something's happened. There's a death of a spouse, or a business is sold, or retirement is near. Something is changing, and they kind of are looking at what to getting some outside advice. So one of the core things is certainly that capital needs analysis, the retirement analysis, financial independence. We call it sustainable spending. We want to solve for, what amount do you need to be saving, if you're still saving, to get to that point where you have financial independence and you can sustain a lifetime of expenses. Many of our clients are already retired, and we're doing that calculation to figure out, okay, what will be your maximum spend? And then not that you need to spend the maximum amount, so just know where what your ceiling is. We can solve for different things. We factor in, what are the standard fixed expenses? What special things are they going to be wanting to fund education for grandchildren? Healthcare expenses, how do we factor that in? What is that likely to look like? In your situation, everybody's really different. Everybody has different family health history. To not customize that a little bit and take that into account, is kind of risky. And the other thing that's interesting is people seem to have really strong ideas about how long they're going to live. And of course, that's really the key question that we can't answer that affects the numbers. Are we just going to want your money to last till age 90, or are we going for age 100? And, we're always going to push that up a little higher because we don't want people to run out of money. But, a lot of times people will say, nobody in my family lived past age 85, and I don't want to deny myself now by not having enough to spend. So all those conversations happen, and we will look at a couple different assessments, and then we redo them often. And as we're just talking with
the number one issue they've done just countless of surveys over the years. The biggest financial issue for most people is, will I outlive my resources?
Yep.
And
Yeah,
with that
that is
fear,
the primary question. It should be the primary question.
yeah, and so the fear is, if I've got to maximize my investment, so hey, an indexed annuity sounds really good because I can't lose, and then and minimize the expenses. And so what I see with the group of 70 and older, they're not spending enough.
Right, right. No, we see that more often than spending too much, for sure. And it's complicated. It isn't as simple as the 4% rule. I mean, it depends on where are your assets, in a tax deferred IRA account or in your trust account. You know, where are your other income sources? What's your Social Security outlook, and are there strategies there? And inflation, taxes.
What's your risk
How much
tolerance?
risk you're going to take. We just had a meeting this week with a couple that is very risk averse, and they shifted to a more to our most conservative portfolio, which is, I think, 70 or 80% fixed income bonds, and we expect that portfolio to return only 4% over the long run. And they were in the more risky portfolio, which is our conservative, which is a 5 to 6% return. And so we had to do a new sustainable spending, and it meant that their spending, they're in their mid 70s, is going to be cut by $500 a month by them sticking with this safer strategy. And we talked about the fact that they're sleeping better at night. That's important for them. Yeah. All those things are important. And I was telling Pete and Trevor that advisors in general have been so busy the last year, not because of the markets, but because of all of the changes that people have been making kind of as a result of living through the last year. Lots of people reassessing their priorities, people moving to other states, people buying different homes, staying, doing a huge remodel, quitting work earlier than they thought, all kinds of stuff, moving in with, the family. So we have to rerun the numbers on that and see what that means as far as spending. So we kind of say that typically we would do that complete analysis every 3 years in a normal environment, but more often if the world changes or if your situation changes. And it seems that we've rerun it for everybody, in the last year or two, a couple times.
Yeah, it's almost like a good financial advisor should have a little, the old green cap, the accountant's hat on, and with a lamp above them and smoking away at their desk and doing the calculations.
Yep. Yeah. And it isn't as straightforward as you think it is. And it's important to reassess everything. And again, with all the tax changes, we're going to need to do that again. So a lot of different moving parts. And that's the thing. That's where, we used to kind of the old way of financial planning, or, some people still do this way, but, looking at everything and doing a very comprehensive overview and financial plan up front. And we do it more on an ongoing basis, kind of taking the different pieces of it. We'll start out with whatever's urgent. Maybe they bought a new property and we need to look at their property casualty insurance and, vet different providers and compare. And we start with that. We do it in pieces. But there are a lot of parts to the financial planning. And if you're talking to financial advisors and they're not asking you questions about this stuff, all they want to do is see your accounts and how much money you have. They're not really coming from a financial planning perspective. And it really is, it is where you come from. And it's different people are attracted to this industry, go in different directions. And, there are people who are really good people and salespeople, and they're going to go in one direction. And there are people who who are the guy with the green cap and the eye shades, whatever, that, that like all of the planning and they're thinking ahead and they want to see how all these pieces fit. And it's maybe not a bad idea to have different people on your team, but you need someone who's really looking at all that and also thinking ahead, what is going on in the world? How are things going to change? That's all important as well. Are your investments properly diversified, and are you, is your strategy appropriate? And we'll get into that in detail next week, kind of where you start and how you look at constructing the right portfolio for you, how that should be done. And it's again, it's could be beautifully simple, and it's the industry complicates it. The industry tries to make you worried and scared and sell you things based on that. What our goal is to get people in the right portfolio so they can stick to it. And that is really the biggest key to investing, not changing your whole strategy based on the short-term fluctuations of the market. And, you know, we were very proud to have not lost anybody last year. We had 2 clients take a little money off the table in the worst of the situation. But, you know, most people, we convinced them to stay invested, and obviously that's paid off better than we would have expected. But we, you know, I think most, that's probably not most, but I mean, we believe in not trying to time the market. Nobody knows what the market's going to do. The longer I do this, the more clear that becomes. Nobody knows. You know, professionals call it wrong all the time. You have a good portfolio that you can stick with, and you ride it out. And what that means, which we'll get into again more next week, but the key is having enough that's not in your portfolio, that's not subject to stock market risk, to provide for your income needs. So we can't design the portfolio until we go through this financial planning, until we know all of these things, and we know, you know, how much you need to spend. Well, you need to get, I'm sorry, 4% isn't going to do it. We got to target 6% return. So that dictates a certain investment strategy. And that may mean that you have 40 or 50% of your portfolio in bonds and fixed income. And that means that that money is there for you to spend before you ever have to sell a stock. And so we do the math. This is what we do when we're in a market downturn. We'll say, yeah, it looks really bad right now, but, you know, in 5 or 10 years, it's going to be fine, or a year, or whatever it is. And you have 8.5 years of fixed income to fund your spending before you would ever need to sell a stock. And that gives people a lot of comfort. That's how we approach it. You shouldn't, I mean, the only way you get hurt in a downturn is to sell. Long term, you know, you make money staying invested in the markets. So tax efficiency is super important. Unfortunately, there's not an easy way to assess the tax efficiency of your portfolio and everything else. I mean, you know, missing some of the tax opportunities can cost you a lot. There's not a lot you can do. So you want to be sure that you're looking at everything you can, as far as how you take your income, your RMDs, how you do your charitable giving. You know, there's ways that are more tax efficient than others.
Capital gain versus ordinary income.
Capital gain, yep.
Qualified dividends. Your overall tax efficiency can pay for any kind of fee that you're paying to the financial advisor.
Definitely. And that, you know, we used to have that as a goal and try to measure it. We actually had an intern who used to try to measure that just on the investment portfolio. And that's, you know, one of the things, again, the brokerage firms and the trust companies, they don't think about taxes at all, it seems like, when they're doing the portfolio. And as far as the trading and having short-term gains, you know, all this stuff, they're just not looking at the tax efficiency. And we end up doing the taxes on some of these, so we see them. Super important to pay attention to tax efficiency.
See, and I love your next line. Have you protected yourself, family, and property?
Right. And that's, you know, when you do go through kind of the financial planning process, when you have your training as a certified financial planner, you kind of start with the risks. You know, you protecting against the risk before you look at investment and maximizing your assets and your gain. Have you protected against all your risks? Do you have an umbrella liability policy? Really easy, inexpensive thing that could be a huge protection for you. What else should you be thinking about? You know, do you have a teenage driver in your house? You know, do you have life insurance if there's somebody, you know, that's still working, whose income the family depends on? All those types of insurance risks, and to have an independent person looking at that, not someone who's trying to sell you the insurance, is important. Long-term care, is that something you want to try to fund with insurance or not? Pros and cons of that. All of those things would be something a good financial planner would look at. And, if you died tomorrow, would the family be prepared? And there's, tons on that. There's of course a whole series that we do on estate planning that gets into the details of that. And, there's the nuts and bolts of getting everything together and making sure that's prepared, you're prepared, but super important to think that through. And that's what, we say, we can't help thinking ahead. We say we're professional worriers. I mean, I'm an optimist, but I also worry about a lot of things. Everybody teases me all the time because I am like the queen of earthquake preparedness. I'm like convinced it is happening in my lifetime. And I and my team are going to be ready. When somebody starts at the firm, we give them the huge Costco emergency pack, but it's like, I'm thinking about that, and I'm thinking about what that means. Do the ATMs shut down? What does that mean for money? What does that mean for clients and how we have things situated? What does that mean for how we access our information? And we decided we didn't want anything, here. We wanted all of our technology in the cloud, and then we have all the backups for that. There's lots of different things to think about how things will play out when bad stuff happens. And the biggest thing about that and risks is, as I've always said, risk is the thing you don't see coming. The problem is we go and now we prepare for the last risk. I mean, I was saying this, being in the airport, and that the airports are still dealing with the stuff that happened from 9/11, when there's probably other risks that would be more important to be looking at now. And I think we do that too. We're now we know how to deal with a pandemic maybe, and next time it's going to be something different. It's going to be something we don't see coming, and you can think it through and try to plan for it. But it's challenging to be prepared for all risks.
Yeah.
Having flexibility and liquidity is important.
Yeah. One of the things too is that what I like about if I die tomorrow, would my family be prepared? Is that most people, and I see some professional financial advisors do the same thing, that the attorney, that's their bailiwick. Yes, it is. It's the attorney who drafts the document, but there are so many money decisions that need to be made that you're much better off talking to a financial advisor about than to the attorney. I find attorneys have no clue about money. They don't know the market. They don't understand money. They know how to draft legal documents.
And I would say that's a little bit true about most CPAs too.
Okay. But so you need to talk over with your financial advisor. Who do you think in my family would be good as to step in if I died tomorrow to take care of all the finances in the household? Do you think one of my family members need a financial plan? How can I help maybe a daughter or a son get started? How should I leave based on my history of my children, how they spend their money? How should I leave my money to them? I find most financial advisors and many individuals leave all those questions over to the attorney, and the attorney, they just don't have that background or knowledge to help most families out. And I think
their relationship isn't, their business model isn't designed to have that deeper relationship with you. You're going to engage them certain price to prepare those documents, and that has to get done.
I would get your financial advisor involved in your estate plan one way or another, especially in choosing your successor trustee and how to distribute your estate.
Right. And I think many advisors are happy to go along on the estate planning appointments too, if you want to include them. And it's, not a bad idea to kind of have a translator on some of it too. Like we actually do a little 3-page write-up in plain English on everybody's trust and estate plan to make sure that it, what you just did, does that really meet your goals? Hopefully we do it in the drafting process, but if not, at least after the fact.
And that's what a comprehensive financial advisor should be doing. And that fee that you paid on a percentage fee that you pay should include all of those services.
Right.
In fact,
and
this is a great next slide.
Yeah, I say, and you know, acknowledging that it is a little weird that the majority of the industry charges on the percent of the investment account when really we're doing all this other stuff. It's just been a model that's evolved to that over time. Partly because people didn't like the idea of writing a check for, you know, a few $1,000s every year for financial planning because they thought that was superfluous. Whereas, you know, the investments, when it's just a part of the investment process, you know, people kind of say, okay, but it allows the advisory firm to have the consistent revenue to provide ongoing financial planning. Which we were talking about, Pete, that's where the brokerage industry has figured out that, oh, we could have consistent ongoing revenue. So now they're, in addition to all the other stuff they're still doing, they're going to charge you an ongoing fee on the account. So you may think you have a fee-based account, but they're not really doing all this other stuff.
Do you have that article, by the way, that you can put up, or is that or do you want to put that up a little later?
Yeah, I can post that later. Yeah.
Okay.
Yeah, thanks.
Oh, by the way, this is what financial planning is about. If you have a child who's in their 20s, 30s, and 40s, don't you think they would be of some help to help with cash flow and budgeting? And as a parent, I don't think you can give that advice. You may want to consider giving as a gift an hourly financial advisor to send your kids to, so that they can write down their goals and find out that they need to save more from their cash flow. So those two things alone would be worth gold to your children.
Yeah, and we, you know, that's a lot of what we do is work with the young adult children of our clients. And, you know, part of that, to what you were talking about a minute ago, Pete, is that part of that process, it's helpful for us to assess their readiness to take on any role when the parents are gone, as far as whether they are up for being a successor trustee, managing their own money and that kind of thing. And it's amazing, of course, the range of what we've seen there, as far as, you know, kids who are so ready and into it and knowledgeable and looking at it the right way, to others like my daughter, sadly, embarrassingly, who has no clue and very little interest. And, you know, I thought I would never want to tie up her money, but she's definitely not ever going to be managing it herself. So, and she's actually fine with that.
Okay. Goals and assumptions. So you want to go through these a little bit, or? Okay.
Oh, these, yeah. I mean, we'll go through them. Yeah, we'll get into them a little bit more. Goals. Okay. What are your goals?
Real quick, you guys, just want to give you a heads up. There's 30 more minutes.
Great. Thank you, Trevor. So, you know, what are your goals? And, you know, maybe the goals are what was back on those first pages. You know, make sure your family's protected, make sure your investments are diversified, make sure, you know how much money you need to live on and what you can spend. I mean, those are the basics that, you know, you should be getting anyway with the financial advisor, but you might have specific goals that you might be wanting to buy a second home, retiring at a certain point. And again, what happens if you are disabled? What happens if you die? I mean, I think there's a lot of planning around, usually around what happens if somebody dies, and you know, that's one direction to plan. And the other is, what if you're disabled? What if you don't die, and you're here and you're not able to work, but you are actually having expenses? Like, that's one kind of planning. So kind of ranking and prioritizing what's most important. It might be helping your adult children get on their feet, helping your, again, grandchildren's education, a big thing. What do you want to do? What do you want to accomplish? Which is something that, you know, you would be discussing this in an early meeting with, you know, a financial advisor, or if you're doing it yourself, just, you know, make sure that you're clear on what you're trying to do here. So when
before you continue on, I just met with a couple, and she wrote a book, in fact, called Thrive Alive. One of the pages, Eve Beck, did a goal planner, and she put in, for goal, she used a term, and I've heard this before, but SMART, SMART, specific, measurable, attainable, realistic, and truthful. And SMART is it's a whole process. And she goes, what are the benefits of doing the goal? What are some of the obstacles of getting to that goal? What action steps are you going to take to reach that goal? Are you using some sort of a tracking system so that you can see whether or not you're getting there? And how are you going to reward yourself for achieving that goal? And so just goal setting alone, to me, I couldn't do it myself. I need someone else to help me set those goals. I'm kind of like your daughter that.
Well, and also when you're dealing with a couple, that there's differences of opinion and dynamics, and a good advisor is really good at bringing that out and bridging those differences. And that's also a big part of what we do.
Number one reason for divorce is money.
Yep.
So having your goals aligned is really important.
Yeah.
Assumptions.
And actually, and when you can't, do you work around that? Okay, he can have this account and do that over here, and you kind of know about that or whatever. Often what it is. So the assumptions that you put into any of the number crunching, obviously very important. 1% difference over many years is a huge difference. And so that's where, there's a ton of software programs out there. There's a lot of do-it-yourself programs, and those can be useful, but you kind of have to know whether you're putting in the right assumptions. And inflation is not always low. It's low right now. I think 2.6 is maybe where we are. So much talk about inflation, now with all the stimulus money that's been poured into the economy. Like, obviously we're going to have really high inflation. Well, not necessarily. Again, it's amazing how none of this is all that scientific, and nobody knows for sure. And there's so many factors affecting it, but there's a lot of arguments about why inflation is not going to be runaway here.
10 years ago, they were predicting high inflation.
Right.
So the experts.
Right. And the Fed learned a lot in the 08, 09 crisis, and I think is managing things really well. I think the effect of the stimulus money, anything there is going to be short term. There's a lot of non-inflationary systemic things that are happening, like technology itself is very non-inflationary. There's a lot of other things driving the economy that is going to probably mitigate spiking inflation. So we're not super worried about inflation. We're watching it, but that it's not a huge concern to us. So we're at about 2.6 right now. When we do our projections, we're using a 3% inflation rate.
Yeah, and each individual has an inflationary mark. If you're trying to put somebody through college, your inflation might be a little bit higher than your next door. If you're looking at purchasing property, you probably need a little higher inflation than the normal. If you don't have health insurance, it's, so each individual, for us as an individual, have our own inflation number.
Yep. And you might use a different number for different projections, like on college costs is a great example there. It's just like, it's so hard to imagine that the college costs could continue to go up the way they have but I think they found that the online stuff isn't working so well. So maybe that gets back to normal and the cost does continue to go up. So obviously the inflation rate is an important one, and then your return on investments. And the calculation is not simply your investment return minus the inflation. Because of the growth of that, it's a modified interest rate calculation, which is why it's, over many years, it's not as straightforward of a calculation as you would think. Fixed income investments, long-term, we're using, it's been about a 4% rate of return over lots of different markets. Stocks have been, 8 to 11, 12% over the long term through everything. And that's, we don't see, we don't usually change those numbers for our long-term assumptions too much based on what's going on presently, because we're using these for 20, 30-year calculations. And the other thing that I think is important, a lot of people will say, I'm retired, I'm 75, I don't have a long-term time horizon. Well, hopefully you have 20 years, you could have 25 years, and, your money, you still have a long-term time horizon. You're not going to need all of that money at any given time. And you still want to think long-term. It's not like all of a sudden you need your money in the next 5 years. So,
but it's difficult for people to spend.
yes.
If I told my mother that she could afford to spend an extra $10,000 a year when she was in her 90s, she would have said I was a spendthrift and to go away and that I didn't know anything about money.
Yep.
And so it's hard for people to spend more.
Well, yes. And as someone who, I've talked to you about recently, Pete, who's got 15 million-ish and will only shop at the Goodwill stores. And she's told me, you like any kind of black pants you want, Laura. It's like, that's the place. And she can't spend it, but she's actually has a terminal illness and she's giving it away now, which is awesome. So, I think you are not running out and she can afford to give it away. And she's getting a lot of joy out of that. It's pretty cool.
It's nice to give.
But yeah, people don't change. It's hard to get people to spend. We've tried that.
Change is so difficult.
Yeah.
Let's go to the next slide.
So cash flow and income statement. So a cash flow statement, I don't have a sample of an actual cash flow statement, but it's basically, what are your sources of income? Are you working? Do you have earned income? Do you have rents from real estate, Social Security, pension payments? I mean, fewer and fewer people have pension payments anymore. When I started the business, they were still pretty common, but boy, don't see a lot of them. So if you have one, congratulations, you're very fortunate to have that. Dividends, capital gains, rent, royalty, which is, we would get all of this. We always want to see the tax returns of clients, and sometimes people kind of forget some of this. We can double check this from what we see on the tax return, but what are all your sources of income and what do those look like? And the character of that income is important, because earned income is treated differently than, capital gains and some royalties, different types of sources. So they're all, it's important to factor that in. And so financial planners all have pretty sophisticated software that lets you plug in all of these things in detail, and it factors in the complex tax character of these different types of income and assets. So for most financial planners, and again, the big firms, they do a financial plan, but they enter the information in 5 minutes, and it's very boilerplate and it misses a lot. I mean, it may be pretty, it may be a fat, printout, but it's not that nuanced. I mean, it takes our team hours to get all the information in accurately to make sure that we're looking at it.
Compared to a medical doctor who gives you a prescription without first taking your blood pressure or checking your heart, your cash flow is literally one of the first things that a professional needs to do.
Yep, looking at all the sources, and then looking at spending. And people always ask, "Are you going to put me on a budget?" It's like, we're not putting anybody on a budget. Well, some people we are. We have a couple that we are, but for the most part, we just, we need to know your spending to put it into our calculation, and you need to know your spending. And again, the tax returns, a lot of times it's kind of like people will say, oh, I'm spending this much, and we'll see, where's the income going, and realize there must be more. Those once a year expenses, your property taxes, your homeowners insurance, whatever. ATM, don't see so much of that anymore, because who takes cash anymore, but it used to be a lot of ATM as a category, and that's not really a category when you're breaking down your expenses. Credit cards, this living expense worksheet. I'm not sure how well everybody can see it, but I'm happy to provide the Excel spreadsheet version of this, or a printed version. If you email me, I can give you this. This is just, kind of what people use. We have clients do this. Lots of different categories, stuff that you might not think about, that really helps you break it down. It's interesting. And along this line of cash flow discussion, this kind of made me think of, I personally have not had a bank account for about 15 years now because I hate banks. Partly. I mean, I have to have one business-wise, but I haven't had one for 15 years. And I run everything through my brokerage account, mostly on auto pay or on one credit card where I get lots of miles and all. So, and so I don't balance, I checkbook, I don't track it that way. And I actually find that my credit card company does a pretty good job of categorizing my spending, which is partly why I run it through there. And it's, it's interesting. I was interested to find out how much I spent on my dogs last year. It was insane. That was like the biggest expense that probably should be cut a little bit, but kind of where are you spending it? Does that make sense? And, are you in line? And everybody's different. There are rules of thumb. People often ask that, but everybody's different. It's really important just to see what you're spending is now. And we'll look at this and think, okay, they're retiring in 2 years, and how are these things going to change too? We'll look and see, how that might change and what that means for the projections that we're going to do. And the projections that we do, we're solving for different things. If someone's still working, we may solve for, okay, can you retire at this date when you want to, or when can you retire? If someone's already retired, we're probably going to say, okay, given what you have and how you're investing, what would be your maximum annual spending? Just so you know, that might be what we calculate for. Or we may say, I want to have $1 million left to pass on to my kids when I'm gone. Or, sometimes we see people worrying more about their kids than they do themselves. So that's something we could calculate. So the balance sheet is very important to kind of track your progress and see where you are. And it's like the first thing that we want to do to look at a client and how we think of a client. All these things are part of the balance sheet. This is a sample balance sheet. I finally have one here that has cost basis on it, Pete, which is super important. And that's like, when I'm talking about a client or thinking about a client, I'm going to always have this in front as I'm thinking about all the different things. When there's a tax law change, I'm going to think, oh, wow, they have this. How's that going to affect them? But, there's different ways to put a balance sheet together. This is just one format. We separate out cash equivalents, regular investment accounts, marketable securities there. Retirement assets we have in a separate category because they're treated differently for tax purposes. You got to chop that number down quite a bit because taxes haven't been paid on it. Life insurance is carried, the cash value is normally carried on the balance sheet, not the death benefit. And we have notes at the bottom that have the death benefit amounts of the policies, but it's the cash value that's included in this state for the balance sheet purposes here. Primary residence, a second residence, personal property, and then any liabilities. And here there's a mortgage and a student loan. So your assets.
When I was at Long Beach State University, one of the first things we did with the professors when I met with them is let's put together a net worth statement, something like what you're showing right here. And 9 out of 10, they underestimated their net worth, or they had never done a net worth statement before, and they had no clue as to what their net worth was.
Right.
And how can you possibly plan if you don't know your net worth?
Yep. And when you get your estate planning done, the attorney's going to ask, what's your approximate net worth, for example. So assets minus liabilities equals your net worth.
Yeah, and cost basis should not be added together. The cost basis is if you're going to sell an asset, so you know what kind of taxes you're going to pay, or if you're going to gift an asset, you know what the cost basis is going to be for the other person.
Right. Yeah. And that
do you see that there's a question on the chat about cost basis?
Yes, that's why I answered
the
question. I hope I answered it.
All right.
And when we are talking to a prospective client, or we're bringing on a new client, we need to know the cost basis on everything, especially the investments that we'll be managing. And I can't believe it, but it's still very common that if somebody goes with a new advisor, the new advisor will just sell everything
and start over.
Like that's like don't ever work with somebody who does that. That's like,
Yeah.
and that some of the big firms do that. It's easy. It's certainly easier for the new
Or
advisors.
it could happen by mistake. A year later, if somebody's selling an asset and they forgot what the cost basis is. And that's why it's so important to have it written down.
Yeah, and the brokerage firms are now required to track that, though some of them don't have all of it, or it's not all accurate, but that's one of the things that we work to make sure that we have the accurate information, because even if we want to get rid of something, it might be too costly from a tax standpoint. So that might be something we put over on the side that we use for a charitable giving, where we gift that appreciated asset because it's too costly to sell it. There's some planning opportunities there.
Trevor, how are we doing on time?
We have 15 more minutes.
Okay, let's go to the next slide.
So risk management, we talked about risk management, different types of coverage. Health insurance, obviously super important. Challenging, as far as what your options are. That's something that we look at. Of course, most financial advisors don't sell health insurance, but we have resources of people we work with to help get that in place and make sure people have what they need. If you're working, disability insurance is super important. A lot of young people are offered disability insurance from an employer and don't sign up for it. It's super inexpensive, especially when you're young. That's important. When you can't work, you'll get some payment for that. As you get older, it gets a little more challenging. If you have your own business, a little more challenging, but something definitely to look at. Long-term care insurance, there's a whole session on that. There's a lot to be said about what's going on there.
Well, there's not very many options.
Yeah, I know.
It's really, you almost have to look at what your net worth is and keep an amount in reserve for long-term care. It's almost the best way.
Right. I mean, it's really sad how people paid in for so long and now they're just cutting the benefits,
We'll go through some of that in the medical care planning.
Yep. And that, actually we've looked at several clients' policies when they had to make a choice of the 8 options or something. Of course, that's something we help with. Auto, homeowners, personal liability insurance, at a minimum, your advisor should be kind of looking through that and making sure there aren't any obvious gaps. Having a couple other insurance people look at it. We don't suggest people just move to get a little bit lower premium. There's a lot of benefit in staying with a company you've been with for a long time, but obviously super important to look at all that. And really most anybody, and if you own a home, you should have a personal umbrella liability policy, $1 million umbrella policy. You can get one for a couple $100. It covers when your auto and homeowners runs out or something that's not covered there. Somebody slips and falls in front of your house. There's, somebody sues you for slander. I mean, there's kind of crazy things that might be covered under a personal liability insurance. Very inexpensive peace of mind there. And then life insurance, whole huge area. Most people do not go shopping well-informed for life insurance. People are sold life insurance. Most people have too much or the wrong kind rather than not enough. The original use of life insurance to protect your family, if you're a breadwinner and something happens to you, term insurance is the best solution for that. It's still really cheap, and doesn't really even matter so much where you buy that because it's not a high commission product. Any other cash value life insurance, super expensive. So much money in that. It's unbelievable. Like really, you just can't even believe it. It's like 150. That I mean, it's. We had a client came to us with like $1.7 million second to die policy that they thought was paid up. They had moved $210,000 into it. The broker invested it in Hong Kong stock future. It was an index life policy. The value dropped to 80,000 of cash value, and in 2 years the policy runs out. And horrible. Just all the time we see that. And actually, a well-known estate planning attorney was part of that transaction that we had to help them get out of and get into something that was going to be more sustainable. There's so much bad life insurance stuff out there. And I used to do a lot of expert witness work in that area. So have seen some pretty bad stuff, but it's great to get an independent review of your life insurance from somebody who doesn't sell life insurance. So, your financial advisors could be a great person to do that, to see, do you need what you have? Is it the best way? There's ways to get into something better, to, maybe get out of it, more tax efficiently, all of that. There's a lot that could be done there. Any policies that you have, you've had for a while, you need to review them every once in a while, especially these cash value policies. Many of them were sold with assumptions that were very unrealistic, and you need to be on top of that before it's too late and it just runs out. Life insurance as an estate planning tool, sometimes that can make sense, but basically you're usually just buying life insurance to increase the size of your estate. It doesn't make your estate taxes go away if you owe estate taxes. It's really, you're just buying life insurance to make your estate bigger. In most cases, there's a lot of, tricky planning things, but, most people don't need that. There's other estate planning tools that probably make more sense. And I don't know if you all heard that it looks like Biden said last night that he's pulling the estate tax increase out of the current bill, which is, great news to all of us and some of the clients who are rushing, trying to get things done here this year. You still have 11.6 million per person until 2025, until they change that. So most people aren't going to have to worry about that. They were talking about reducing it to 3.5 million per person. But again, as of last night, they were saying that's off the table. But what is still on the table is a step up in cost basis, which can be even more damaging to some people's estates potentially. But that's a whole other conversation. And just what I would say about just experience, I had a call of a study group of kind of advisor panel of peers that I've been with for 25 years from around the country, and they are all owners of their own firms. And we talk about a lot of different things. And we were talking about the potential tax law changes on the table, and how many changes there have been over our careers, and it's in, it's out, what we think it's going to be, and people often rush to do planning that they can't undo and make, kind of bad decisions in a panic mode. And we've seen parents giving away a lot of their assets over the last year because they were afraid the estate tax thing was going to change, and, giving away more than they really should be giving away. And the laws are going to change over, every year, every administration. You have to pay attention to it and do what you can, but be really careful about some of these irrevocable planning things that that you might undertake. So with that in mind, and running out of time, it's obviously
tax plan we did on the first session, Laura, so you can skip this one.
Okay, good. Yeah, we don't know what's going to happen, but rates are probably going up, but not for most people.
Yeah, but we did an entire 45 minutes on tax planning.
Okay, cool. All right. Then that's pretty much it before we go into investments.
I would like for you to pull up that article if you have it.
I don't have it.
Okay.
Well, actually, I could.
No problem. Talk a little bit about it.
Which it says that UBS ropes in new fee generating assets. They reported robust first quarter earnings by getting fees from steady, more dependable, less affected by the whims of the broader market and brokers pumping products for commissions. UBS wirehouse competitors have reported strong earnings, blah, blah, all the different advisors out there trying to gather assets to put in their fee program. So it doesn't mean that they're not selling you all the other stuff. It doesn't mean that you're getting financial planning just because they're going to charge you a fee on the assets.
Yes, that's the point. Just because a broker doesn't charge, just all of a sudden just charges you a fee does not mean that they're all of a sudden doing financial planning.
Right. And commissions are, kind of a way of the past. They still exist. They're usually more hidden on annuities and life insurance and stuff. But it's all the different fees that a brokerage firm can get from you. All the cross-selling. I mean, the worst of them, one of the worst is banks like First Republic. I mean, they'll give you a little cut in your mortgage rate if you put money with them, and then they do every crazy thing with your money. You know, there's different versions of that, but you know, there's no free lunch. You know, sometimes they'll cut a fee one place and they're getting it in another way that's a little more hidden.
Yes. Be careful with your money. You know, it's your money, and we should have a little tagline under it, and everybody wants it. And especially in the financial services area, you know, it's the complexity is just huge, and they want to make it more complex so you don't understand it, and therefore they will generate more fees. It should be very, very simple. Every quarter when you do an update for your clients, Laura, do you tell them how much you made that quarter?
Yes.
Yeah.
Yep. And it's all, you know, it's posted online, and it'll show what we billed and what their account made. And, you know, just along those lines where, you know, we've ever got questions, which hasn't happened in a long time because we've had such a great market.
Yeah.
But when the market goes down, you know, sometimes you might say, well, why am I paying you? I didn't make any money this quarter. And of course, as we talked about, the fee that we're charging to manage the assets is really kind of the fee for the whole relationship that we have with the client, where allows us to do all the other things and not be incentivized to sell them stuff and to do things not in their best interests.
And if you have a financial advisor and you're not getting all of these services, then you're overpaying, or you need to ask more questions and say, can you provide me blah, blah, blah? Or can you review my auto insurance to see if it's adequate? Can you review my homeowner's policy? You know, how does this compare to Geico or Allstate? You know, it's if you don't ask or initiate questions, maybe the financial advisor is maybe thinks that you don't want to have more involvement.
And you know, Pete and Trevor and, you know, the people who are involved with these seminars are really a good resource. I mean, we're all coming from that fiduciary space, and we like to support other people who come from that. I mean, that was kind of my goal and mission when I was teaching over all those years. And I have to say, since I stopped teaching at UCI, the program's taken a little turn to the dark side, as I would say. Seems to be a lot of brokers involved in the program, you know, kind of teaching things a little differently.
Yeah. Financial planning is a vocation. It's not a sales job. And you can have such a great impact on other people's lives and helping them with their money. And because where you spend your money is also what's important to you. And it talks about values of those things that are important to you and to your family.
Well, thank you guys. Next week we'll have Laura back, and she'll be going into investment planning. Laura, can you give us a little snippet of what to expect? Are you going to tell us the secret sauce and all the hot stock picks?
Yeah, right. Kind of the basic tenets of investing, what you need to worry about, how to stay out of trouble, you know, an easy way to do it yourself if you don't want to work with somebody, and, you know, what to avoid, you know, what matters.
Great.
Wonderful. Okay, well, thank you everyone for attending. We'll see Laura next week. Those of you that will be here tomorrow for week 3 of It's Your Estate, we will be starting at 10 o'clock. And have a great rest of your day. Great spring day.
Thank you, Trevor. Thank you, Laura.
Thank you.
Bye-bye.